India's IPO market is having one of its biggest years ever.
Now let's talk about the Indian stock market.
Mega IPO
2025, 65 IPOs launched so far. The decibel of the buzz in the IPO market is actually hard to ignore at this time.
The IPO.
46 IPOs raising over 90,000 crores in just 6 months. That's more than half of last year's total. And the results? Still impressive. 61% of the IPOs listed since January 24 beat the Nifty in the last 6 months, with average listing gains of 22%. And smaller IPOs below 200 crore gave nearly 40% gains. Sounds like every IPO is a win, right? Not really. Because behind the buzz, there's growing hype and a few red flags. One recent IPO was priced at 235 XP. 70% of it was just promoters cashing out. That's not going public for retail investors. That's exit liquidity for a few people. That's the new phase of India's IPO story. Big opportunities, bigger speculation. Which is why, now more than ever, investors need to pause and analyze. So in this video, we'll break down the 5 key factors you must evaluate before applying for any IPO, from offer structure to valuations. Because in a market overflowing with new opportunities, it's not just about getting an allotment. It's about getting it right. Factor 1. Checking the IPO details. Now, when a new IPO hits the market, most retail investors rush straight to check the price band or the subscription status. But the first and most important thing you should look at is where your money is actually going. That is the structure of the IPO itself. Every IPO can be broken into 2 parts. A fresh issue, where the company is issuing new shares to raise fresh capital, and an offer for sale, where existing shareholders sell some of their pre-owned shares to the public. Some IPOs can be a mix of both. You can find these details in the objects of the issue section in the red herring prospectus or RHP, one of the most revealing parts of the entire document. Let's see the section for the Physics Wallah IPO. Now, if the funds are being used for organic growth, like expanding capacity, launching new products, or investing in technology, that's usually a healthy sign. It means the company has a long-term plan and wants to reinvest in its future. But if the company is raising money mainly to repay old debt, then you need to be careful. A little debt repayment of around 20 to 30% is fine. It improves the balance sheet and reduces interest costs. But if more than half the IPO proceeds are going just to pay off loans, it may indicate financial stress. In that case, the IPO might be more about survival than growth. Fresh issues are generally positive. They bring new capital to expand the business. But remember, they also dilute existing ownership. Since the total number of shares increases, the earnings per share reduces slightly in the short term. Now look at the offer for sale part in the Physics Wallah IPO. Here, the money raised from OFS doesn't go to the company. It goes straight to the shareholders selling their stakes. That's not necessarily a red flag, but it definitely deserves a closer look. So before you hit that apply button, always start here with the structure and the purpose of the IPO. Ask yourself 2 simple questions. Is this IPO raising money to grow the business or to let someone else exit? And is my capital being used for future expansion or just to clean up old balance sheets? Factor 2. About the business industry analysis, growth potential, and total addressable market. Once you've understood where your money is going, the next big question is, what exactly does this company do and how big is the opportunity it's chasing? Because let's be honest, applying for an IPO isn't just about grey market premiums or hoping for quick listing gains. It's about buying into a business and an industry that can actually grow. Let's start with the business model. Every RHP clearly explains how the company makes money, its products, customers, cost structure, and the core problem it solves. Your job is to understand whether the model is sustainable, scalable, and profitable. Ask a few basic but powerful questions. What is the company selling? Who is the target customer? How diversified are its revenue streams? And also, is it capital heavy or asset light? For tech-driven businesses like Grow or Lenskart, focus on how technology drives customer acquisition, retention, and operating efficiency. For manufacturing companies, study production capacity, utilization, and how much capital they need to grow. The key is to look for positive unit economics, meaning each additional customer adds to profit, not losses. Take Physics Wallah for example. They run a hybrid model, online and offline. Simply by observing the number of students enrolled and total revenue generated through them, you can find out average revenue per user. You can do it separately for online and offline channels and also for the aggregate. By tracking this metric, you will have a fair idea of how the business is doing. Next comes the industry analysis. This is where you zoom out and see the bigger picture. How fast is the sector growing? What's the demand cycle like? Who are the major competitors? High growth industries like digital payments, EVs, data centers, or financial services can grow at mid to high double-digit rate annually, creating huge opportunities. But cyclical sectors like real estate or capital goods rise and fall with the economy. Also, don't ignore regulation and disruption. Highly regulated sectors like banking or telecom face policy risks, while tech-heavy industries can change overnight with innovation. And if the sector depends heavily on imports, that adds foreign exchange and margin pressure. Finally, let's talk about the big one, the total addressable market or TAM. TAM simply means the total revenue opportunity if the company captured 100% of its potential market. It answers the question, how big can this really get? You will get this data in the industry overview section of the RHP. It usually includes industry growth rates, total market size, and competitor landscape as well. Here's how you can approach it simply and ask for Physics Wallah. What is the total market size the company operates in? It's 24 to 26 trillions by 2030. How fast is this market growing annually? 10% CAGR. What share of this market does the company currently hold? Exact market share is not known, but a dominant presence in all categories of its market. How much of this market can the company realistically capture in the next 3 to 5 years? With paid users compounding at nearly 60% CAGR, it appears well positioned to rapidly deepen its market share over the next 2-3 years. Is the industry new and expanding or mature and saturated? The classroom coaching industry has been there in India for decades, but still growing because of the demographic dividend. Online coaching has gained traction in the last 5 years only. Factor 3. Unique differentiation, competitive positioning, market share, and moats. Now that we know what the company does and how big its opportunity is, the next big question is, what makes this company special? Because in the long run, only those businesses survive that stand out. Every IPO will tell you that it's a market leader or first mover, but your job as an investor is to look deeper and to figure out whether the company truly has a competitive edge or it's just another player in a crowded market. Let's start with competitive positioning. This basically means where does the company stand compared to its rivals? Does it lead the pack or is it fighting for space? Most RHPs include this in the industry overview section. You'll often find a chart or table comparing the company with competitors on things like revenue, profitability, and sometimes market share. But remember, for these numbers that are provided in the RHP, always cross-check by looking up individual companies' databases like annual reports and corporate presentations as well. Ask yourself, who are the top competitors? What's the company's market share compared to them, if it's mentioned? Is it competing on price, brand, quality, or innovation? What is their mode of delivery? And how much do they spend on marketing to acquire and retain customers? For instance, you can see here how different competitors of Physics Wallah spend differently on marketing. Factor 4. Financials, strength and weaknesses. Now, have you noticed every IPO pitch looks glossy? Strong growth numbers, big future plans and fancy slides. However, the real story is hidden in the balance sheet. Yes. Let's start with the basics. The company's financials and key operating metrics. Whenever you go through the RHP, don't just focus on the profit and loss statement. Spend time on the balance sheet and the cash flow statement too, because that's where you find the truth. From the P&L, look for revenue growth and profit margins. Now, consistent 20% growth with improving EBITDA or net margins shows scalability. But if profits are growing faster than revenues, check if that's sustainable or just a one-time gain. Because most of the times these IPOs, especially the smaller ones, are dressed up, before they come for an IPO. That is why you turn to the balance sheet. Check the leverage levels. A debt to equity ratio below 1x is generally healthy. Then check the cash flow statement. Look for positive and growing cash from operations, because profits without cash flow often mean accounting gains, not real money. Once you've seen the numbers, balance the picture. What are the company's strengths and weaknesses? Strong companies show clear financial and strategic strengths. Consistent double-digit revenue growth, expanding margins, robust operating cash flow, and high ROE or ROC are signs of a business that's growing with efficiency. Operationally, they'll show production efficiency, a diversified supplier base, and a strong distribution network. Strategically, they'll have credible management, clear growth strategy, and long-standing customer relationships. But every strength has a mirror image, the risks. And the RHP's risk factors section is where you find them, the most honest part of the document. Let's look at few risks cited by Physics Wallah to understand this better. First, consistent losses. Physics Wallah has reported losses and negative net worth. Unless revenue grows faster and costs are controlled, financial stress could continue. Second, high dependency on students and faculty. As a hybrid platform, Physics Wallah depends equally on attracting students and retaining teachers. Any disruption on either side can directly impact performance. Third, geographical concentration risks. A large share of revenue comes from a few key offline centers, which means slower expansion or weak regional performance can hurt growth. And lastly, brand risk. The brand is central to the business model. Any reputational issue or negative publicity can affect enrollments and overall trust. At the end of the day, no company is perfect, but a great investment is one where the strengths clearly outweigh the weaknesses, and where management is transparent enough to admit what could go wrong. Factor 5. Valuation and fair pricing. Even the best businesses can become a bad investment if you buy it at the wrong price. That's why understanding what you're paying for versus what you're getting is the most crucial part of IPO investing. When a company launches an IPO, its price is based on calculations done by merchant bankers outlined in the basis for issue price section of the RHP. Most IPOs use relative valuation, comparing themselves with listed peers using ratios like PE ratio for profit-making firms or EV or EBITDA. But when there is no listed peer, the RHP clearly mentions that too. Take Physics Wallah's case. At the time of its RHP, the final price band was not decided. And since it did not have a listed peer in India, that disclaimer was clearly stated. But when there are peers, that's your reality check. If a company with similar growth, margins, and risk trades at half the valuation in the secondary market, then the IPO isn't a great opportunity. It's just expensive storytelling. However, one must also keep in mind that a high PE or EV or EBITDA multiple isn't bad by itself. It just means the market already expects future growth to be perfect. The real question is, can the company actually deliver what the price is already promising? Because if growth slows, margins shrink, or sentiment turns, overvalued stocks fall the hardest. So how do you actually figure out if an IPO is fairly valued? Here's a quick 5-question checklist every smart investor should ask. First, at this price, what kind of realistic returns can I expect in the next 3 to 5 years? Second, is this company priced for perfection? Are we assuming everything will go right? Growth, margin, sentiments with no room for error? If yes, that's dangerous. Always look for a margin of safety. Third, how does it compare with listed peers? Am I paying a huge premium for the same business quality? Fourth, and if yes, is that premium really justified by stronger growth or profitability? And fifth, do the numbers actually make sense? Are those revenue and profit projections even possible given the market size and competition? So now you have the complete framework. Understand the structure, know the business, check its differentiation, assess the risks, and finally, value it sensibly. If you found this breakdown useful, share it with someone who's planning to apply for the next big IPO and help them invest with logic, not FOMO. For more such insightful videos on investing in markets, don't forget to hit the like button and subscribe to our channel. Thanks for watching and see you in the next one. How do I start again now? Oh. Wait. Sorry, there is. Sorry. कुछ भी नहीं बोलूँ. I was in the middle. Sorry.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.